Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome back, or welcome to the Physician's Guide to Financial Wellness. This is Andrew Mushbaugh, and I'm joined, as always, by my co-host, Trent DeBruin. And before we jump into our topic for today, we wanted to take a minute to give a quick update that this will be our last podcast episode, at least for now, which is bittersweet. And while we really enjoyed discussing and sharing our perspective, we also want to make sure we follow our advice with striking the right balance in our own lives. With that in mind, we're at a point where the majority of our quote-unquote work time is focused on serving our existing clients and continue to take on some new ones. And we want to continue enjoying our extra free time with our families, including our kids who are growing up at way too fast of a clip. So after 65 episodes, we're taking a pause for now, but we may resume at some point in the future. And no, we didn't run out of bad dad jokes. There's an endless supply of those.
Yeah, sadly, that's very true. But joking aside, we appreciate all of our listeners following along and sending us questions and supporting us over the past 3 years. We hope we were able to provide some useful content and perspective, and we'll be happy if even one listener was able to get a little bit closer to their version of financial wellness as a result of listening to the show.
Yeah, exactly. And I'll just echo what Trent said, that we really appreciate everyone listening and following along with us. Okay, so with our quick podcast update out of the way, we'll jump right back into today's episode, which, for better or worse, has been hard to not feel the impact of, and that's rising interest rates. And before you immediately close out of your podcast app, we promise this won't be a lecture on economics, but rather a more practical discussion around where things are today and how this dynamic impacts people in different ways. So with that in mind, we'll discuss, number one, the current environment we're in, a brief refresher on what interest rates are and what they impact, both now and from a higher level perspective. Number two, how interest rates have a differing impact depending on what phase of life you're in, from a first-time home buyer all the way through to retirement. Number three, how our current environment compares to other decades and time periods to provide some historical perspective on how normal this is or isn't. And lastly, number four, how to plan around the current environment to maximize the opportunities today while also thinking through how to plan ahead and what to be aware of. All right, Trent, discussing an entire podcast around interest rates. Is this bringing any good memories back from the time at University of Chicago getting your MBA?
Actually, it is. I loved my class on macroeconomics and the implications for the business and investment environment, but I'll try to tame my excitement here.
Well, we're past the point of trying to hide how much we enjoy these topics. I like it.
Well past that.
Well, why don't you kick things off by taking a trip down memory lane with an initial overview of interest rates and where we are today?
Sure. So an interest rate has two different perspectives depending on whether you're the borrower or the recipient. If you're borrowing money, like a mortgage, the interest rate is the amount you have to pay each year on the money you're borrowing. Conversely, if you're lending money to someone else, like depositing cash in a bank, the interest rate is the amount you earn on the money you're lending. To give a quick example, most interest rates are quoted as an APR, or annual percentage rate. So if you see that an online bank is offering a 4% interest rate for money held in a savings account, this refers to the annual amount you'll earn on your deposit. Putting some numbers to it, and without factoring in daily compounding or any other nuanced factors, if you deposited $100,000 on January 1st, you would have $104,000 on December 31st, aka you would have earned 4% or $4,000 of interest on your money through the course of the year. So that's just an extremely basic definition of interest rates, and it's worth mentioning again that a high or a low interest rate will have varying meaning and impact depending on whether you're the borrower or the receiver. Interest rates vary depending on the financial product in question, and if you think about one of the extremes, credit cards, you'll often see an annual interest rate of 20% or more. For any lender, assuming they're paid back the amount they lend, they're happy to earn a 20% plus annual return on their money. On the flip side, if you're the borrower, at an interest rate that high, credit card debt can quickly spiral to the point where you're unable to even make the required interest payments, much less pay down the principal of your credit card balance. For example, if you have $10,000 of credit card debt with a 20% interest rate, you'd have to pay around $2,000 of annual interest until you pay down the $10,000 you're borrowing. This is why you'll often hear about quote-unquote good versus bad debt. Having debt simply means borrowing money, which in the case of credit cards, the cost of borrowing that money is extremely high, and this is considered bad debt. Whereas for a mortgage, which is considered good debt, the interest rate is much lower, and at the same time, you're borrowing money to purchase an underlying asset that increases in value over time. In other words, mortgage debt is good debt because the interest rate is much lower, you have more time to pay off the loan, often 30 years, and by paying off the loan, you're building equity by becoming the owner of an appreciating asset. And on that note, Andrew, why don't you share some additional context around how to compare interest rates and whether current interest rates are good or bad, depending on your unique situation and phase of life?
Sure. And as we mentioned earlier, there are two perspectives you can take when looking at interest rates, the borrower or the lender, which, as you can imagine, results in totally different feelings about the current level of interest rates. While it's a relatively basic concept, it's worth repeating just to make sure we're starting on the same page. If you are borrowing money from someone, like taking out a mortgage, you'd like to pay as little interest as possible. And if you're going to lend someone money, like depositing money in a bank, you want to earn as much interest as possible. For example, why would you want to leave $100,000 at a large bank like Chase or Bank of America, where you earn a 0.1% return on your checking account, when you could park that same $100,000 at an online savings bank and earn 4% plus, which results in you having an extra $4,000 in your pocket at the end of the year? So knowing there are two different perspectives around whether interest rates are good or bad, at least from a general standpoint, it's helpful to dive a little deeper into how this applies to your unique situation. The easiest way to think about how the current level of interest rates impacts your situation is by looking at your life stage. Are you younger, currently renting with a young family and about to buy your first house? Or are you about to retire with your mortgage paid off? Or are you somewhere in between where you own a house and are still paying on a mortgage? Starting with the first example of a younger person who's about to become a first-time homebuyer, you're in a position where you are earlier on in the process of accumulating assets for various goals, with one of them being a down payment on a house. Using some numbers, let's say you have $200,000 currently saved up. Well, yes, of course you'd like to earn a 4% interest rate, the current interest rate for many high-yield savings accounts, on the cash you've saved versus the 1% interest rate these accounts were paying a few years ago. But let's look at the other side of the coin. If you buy a house for $750,000 and put down the full $200,000 as a down payment, that means you were taking out a mortgage of $550,000, almost 3 times the amount of cash you have. When interest rates for savings accounts are low, like they were a few years ago, that means mortgage rates are also low. They were around 3% just a couple years ago. And when interest rates for savings accounts are higher, like the current roughly 4%, that means mortgage rates are also higher, currently above 7%. So for a younger family looking to buy a home, a higher interest rate environment is relatively worse for you than the rest of the population because you are stuck paying a higher interest rate on the money you borrow, the mortgage, for the home purchase. Whereas looking at the other end of the spectrum, if you're a couple in retirement and your mortgage has already been paid off and you don't have any planned purchases that would require debt, you don't have to worry about the higher cost of borrowing. Instead, you're in a position where you can earn a higher interest rate on your investments, like bonds or cash, and given the higher dollar amounts you've accumulated by this point in your life, the actual hard dollars and cents benefit is much greater. In other words, a 4% interest rate on $100,000 is $4,000, but a 4% interest rate on $2 million is $80,000. That's certainly not to say that anyone with $2 million accumulated for retirement would have everything in cash, but the concept is the same, that having accumulated more money, the impact of earning higher interest is more significant in terms of helping you earn a return on your money and fund your lifestyle. So those are two of the quote-unquote extremes, but there's also the cohort in the middle where the impact is relatively neutral. You may already own a house, but could be impacted if you're looking to move into a bigger forever house, but you'll also likely have a higher amount of investments and assets accumulated that can earn more for you. So that's a relatively basic overview of how the life stage you are in determines how much you will feel the impact of a higher or lower interest rate environment. But there are certainly other ancillary factors that come into play, like the impact of inflation or deflation on the broader economy, which we'll avoid going into the weeds on in this podcast episode.
We did promise to avoid too much economic theory today, so I'm glad we're sticking to that promise.
Exactly. Yeah, it was a close call.
So that's an overview of the impact of higher or lower interest rates and how it varies depending on your life stage. And the next thing we want to do is provide some historical context, or at least a few points of comparison, on where we are today versus other periods in the past. Well, to start off, and apologies to any soon-to-be or recent homebuyers, but you may have seen the recent headlines that mortgage interest rates have reached their highest level in more than 20 years. So that's a snapshot of where we are right now compared to recent history. And before we add some historical context going back several decades, it's worth noting how unique the current environment is, because it was only 2 years ago that mortgage interest rates were in the 3% range, at their lowest level ever. In other words, interest rates have more than doubled, and in some cases tripled, over a 2-year time period, with 2022 witnessing one of the most abrupt one-year increases in interest rates ever. So yes, earning 4% interest on your cash and having mortgage rates in the 7% range is being felt and noticed by almost everyone because of both A, how quickly the increase has happened, and B, how long it's been since we last saw this level of interest rates. This is where it's helpful to zoom out and look beyond any 1, 5, 10, or even 20-year period to see how it compares to the past many decades. For anyone in their 60s who's nearing or already in retirement, you may have a different feeling about 7% mortgage rates, either a concern that things can get worse from here, or possibly a feeling of, oh, that's nothing, as you think back to buying your first home in the 1980s when mortgage rates were in the teens, i.e., similar to current credit card levels. So at their peak, at least in the past 50 years, interest rates were significantly higher in the 1980s than at any other point. And as a result, this subsequently led to an unprecedented period of 40 years where interest rates steadily fell before reaching their low in 2021. However, just like trees can't grow to the sky, eventually there becomes a point where interest rates can't rise further, as the impact of higher interest rates is felt by the economy and inflation and economic growth slows, and interest rates then begin to fall again. And we'll continue to discuss interest rates in the context of a 30-year mortgage rate because that tends to be easier to digest. So the two extremes were the early 1980s when interest rates reached the high teens and the year 2021 when they fell to just below 3%. But in between, we've seen periods where rates have been relatively stable within a range, 6 to 8% in the 1990s, 5 to 7% in the 2000s, and 3 to 5% in the 2010s. And I know we just threw a lot of numbers out there, but the goal was to illustrate the point that an extreme jump like we've experienced recently is more the exception than the rule. Looking at historical trends, it's unlikely that we'll experience another similarly sharp increase anytime soon. However, just like with the stock market, it's impossible to time or predict exactly what interest rates will do and when, but it is helpful to remind yourself that at some point there will eventually be a normalization and another decrease.
Yeah, everything would be a lot easier if we just knew exactly where the stock market would be in 1 to 2 years.
That would be pretty convenient.
Well, since we can't perfectly time interest rates, I guess the next best thing is to plan around what we can control using educated assumptions. I know, pretty unpredictable from us, huh?
Yep, a consistent message to go with our consistent bad dad jokes.
Oh, we just shared some of the context around where interest rates are today relative to other periods of time. So the next step is making sense of what are the potential planning opportunities for the current environment. And I'll start with what you shouldn't do, which is to second guess prior decisions or fall prey to hindsight bias of saying you wish you had bought a house, refinanced, or did something different 2 years ago. Yes, it would have been nice to lock in an all-time low interest rate, but those opportunities are no longer available, and life doesn't work out perfectly for everyone in terms of timing of the interest rates. So starting with two more immediate changes of how to plan around the change in interest rates. Number one, ensure that you're maximizing the interest rate on any cash on hand by utilizing a high-yield savings account for excess cash beyond the base amount you hold in your checking account. And two, which is more relevant for those looking to make a larger purchase, like a car or a home, consider trying to build up a larger percentage down payment. When interest rates were at historic lows, it was typically optimal to put a lower percentage down, say 20% or potentially even less, and invest any excess with the expectation of earning a higher return on that money. However, with interest rates at 7% or higher, the spread between the interest rate and the return that you'd expect to earn by investing that money has narrowed. Yes, you would still expect to earn a higher return over longer periods of time by investing in the stock market, which has historically provided a roughly 10% annual return, but it isn't guaranteed every year. This is why within the past year or so, we've been recommending people build up a higher percentage down payment, or if possible, delay larger purchases in order to avoid taking on too much debt at higher interest rates, thus stressing monthly cash flow from the higher associated monthly payment. We've also been recommending avoiding debt when possible, i.e. paying for a car in cash rather than financing it. Another strategy is to consider the type of mortgage or loan you use. For example, potentially using an adjustable rate mortgage at a lower rate if you either plan to be out of the home before the rate resets, or if the rest of the period is long enough that rates are more likely to fall than rise between now and then. This can help to lower your required payment compared to a 30-year fixed mortgage. Moving forward, it's also helpful to understand opportunities that may materialize regardless of where rates go from here. If interest rates decline, you can always look at refinancing, like many people did throughout the 2010 to 2021 era when rates were falling. Or you could potentially even look at cash out refinances to take back some of your capital and now look to invest the money if you put a higher percentage down in the first place. On the flip side, if rates go up from here, the blessing is that your cash will earn more money for you, and you can be diligent about taking advantage of high-yield savings accounts to maximize that interest. And the message remains the same of trying to build up more cash to pay for items versus relying on financing to make purchases. So the main takeaway here is to focus on what you can control and capitalize on the opportunities that are available, which is simple in practice, but as with most things in financial planning, doing the little things can really add up over time. Well, that's everything we wanted to cover today regarding the current interest rate environment. We hope that this provided some additional perspective and is helpful in not only making sense of the headlines, but also trying to tie things back to your situation and what it means for you. So to give a quick recap of what we discussed today, number one, we gave a quick overview of what an interest rate is, and the definition has two different perspectives depending on whether you are the borrower or the recipient. If you are borrowing money, like a mortgage, the interest rate is the amount charged to you on the money you borrow. Conversely, if you are giving your money to someone else, like depositing cash in a bank, the interest rate is the amount you will earn on your money. In other words, if you are a borrower, you don't like high interest rates, whereas if you are a lender or receiver, you benefit from high interest rates. Number 2, we discussed the impact of a high or low interest rate environment and how it impacts